Financial planning must consider the broader economic conditions and the various markets that constitute the economy. The labor market, for instance, facilitates the exchange of labor through hiring or employment, where workers vie for job opportunities and employers compete for skilled labor. In the capital market, capital in the form of cash or assets is traded primarily through stocks and bonds, alongside other capital packaging methods. Within the credit market, a subset of the capital market, capital is loaned and borrowed rather than bought and sold. These markets operate within a dynamic economic landscape, and understanding these environmental dynamics is integral to sound financial planning. Over the long term, historical evidence suggests that economies tend to grow, investments can yield returns, and currency values generally remain stable. However, this may not hold true in the short term, as periods of economic downturns or uncertainties can disrupt financial plans, particularly if they persist or coincide unfavorably with one's life stage. Knowledge of overarching economic trends and indicators that gauge economic health can aid in making informed financial decisions. These systemic factors encompass business cycles, employment rates, and other key economic indicators. Business cycles. An economy typically generates enough output to meet the needs and desires of its constituents. Generally, economic output expands with population growth or increasing consumer expectations. The productivity of an economy is gauged by its gross domestic product, representing the value of goods and services produced within a specific time frame. An ascending GDP signifies economic expansion, while a declining GDP indicates contraction. A contraction lasting for 6 months or more constitutes a recession, while a prolonged recession is termed a depression. Economies tend to exhibit cyclical patterns over time, characterized by periods of expansion and contraction known as the business cycle. Contraction phases are often regarded as market corrections, where the market realigns to achieve equilibrium following periods of growth. However, economic growth is rarely uniform, leading to occasional imbalances in specific markets that necessitate corrective measures. Various metaphors, such as peaks and troughs, boom and bust, growth and contraction, and expansion and correction, are employed to depict the cyclical nature of market economies. While each cycle emerges from unique circumstances, they all stem from changes that disrupt economic equilibrium. Fluctuations in the balance between supply and demand trigger these cycles. Instances where demand outpaces supply or vice versa prompt reactions from buyers and sellers, precipitating further changes in the economy. Ready to take charge of your finances with confidence? I've curated a detailed monthly budget template just for you. Access it now via the link in the description to begin your path towards financial success. Don't wait, take action and transform your financial planning today. Employment rate. An economy serves not only to produce goods and services for its members' consumption, but also to generate employment opportunities. The majority of individuals engage in the market economy by offering their labor, with wages typically serving as their primary income source. Consequently, the economy must offer avenues for earning wages to facilitate broader participation in the market. Otherwise, alternative means of support, such as private or public subsidies, must be provided to accommodate those unable to secure employment. The unemployment rate serves as a metric for assessing an economy's deficiency, indicating the proportion of individuals willing to work but unable to find employment due to inadequate job availability. While there exists a natural rate of unemployment as individuals transition in and out of the workforce due to life circumstances, such as career retraining or family commitments, this rate should ideally remain consistently low and not impede the economy's productivity. Moreover, unemployment reflects inefficiencies within the economy, as it signifies the underutilization of productive human resources. The employment rate, also known as the labor force participation rate, serves as an indicator of an economy's efficacy in creating opportunities for labor engagement and efficiently utilizing its human resources. A robust market economy maximizes labor productivity, overall productivity, and consumer satisfaction by offering ample employment prospects through its markets. Extremes at either end of the growth spectrum render the economy unsustainable. Rapid growth results in excessive demand for labor, whereas contraction leads to insufficient demand. In scenarios of labor demand outpacing supply, wages escalate, elevating the cost of goods and services and triggering inflation. Typically, prices rise faster than wages due to various factors, curbing consumption and ultimately slowing the economy's pace from its booming state to a more sustainable rate of growth. Conversely, when labor demand lags behind supply, wages decline, unemployment ensues, or both. Lower wages may theoretically incentivize employers to expand their workforce, thereby elevating employment levels. However, this dynamic doesn't always unfold as anticipated, as individuals possess job mobility, enabling them to seek employment opportunities across different economies. Elevated and prolonged unemployment signifies a significant portion of the population enduring extended periods without income, rendering them unable to engage in economic transactions due to a lack of resources to exchange. In such instances, the market economy fails to cater to the needs of a substantial segment of the populace, resulting in discontent that often precipitates demands for change. Historically, many revolutions have been instigated by such grievances, highlighting the societal repercussions of persistent economic inequity. Other indicators of economic health. Various economic indicators provide insights into the overall health and trajectory of our economy, signaling its level of success, growth, and readiness for future expansion. These indicators encompass a range of statistics, including housing starts, existing home sales, orders for durable goods, consumer confidence, producer prices, and more. However, among these indicators, GDP growth and unemployment hold particular significance as they encapsulate the core objectives of our economy, fostering diverse opportunities for widespread participation, job creation, and fulfillment of consumer needs. A thriving and robust economy offers an array of choices to its participants, including ample opportunities for labor and capital transactions. It presents increased possibilities for earning returns or income, thereby fostering diversification and mitigating risks. While an ideal scenario entails perpetual operation within a healthy economy, this is not always feasible. Financial planning necessitates accounting for the potential impact of economic factors on financial realities. Economic downturns, such as recessions, can elevate unemployment rates, thereby diminishing labor returns, wages, or complicating income forecasts. In some cases, wage income may be lost altogether. Such temporary involuntary disruptions to wage income are expected to occur over one's lifetime, given the inevitability of economic cycles. Investing to establish alternative sources of income serves as a safeguard against potential loss of wages. However, during periods of economic downturn, the efficacy of capital, along with its value, may diminish. While certain sectors such as public education and healthcare are deemed resilient to economic cycles, overall investment returns may face challenges. Consequently, throughout one's lifetime, fluctuations in business cycles are likely to impact participation in the capital markets as well. Currency value. A stable currency value serves as a crucial indicator of a robust economy and plays a pivotal role in financial planning. Currency value hinges on its utility, primarily as a medium of exchange and trade, which in turn depends on the productivity of the economy. If an economy produces goods and services that are in demand, its currency holds greater value relative to others, as it is more sought after for transactions. The usefulness of a currency is gauged by its purchasing power, the extent to which it can acquire goods and services. The greater the purchasing power, the more valuable the currency. Inflation occurs when prices escalate, diminishing the purchasing power of the currency, thus reducing its value. Conversely, deflation transpires when prices decline, enhancing the purchasing power of the currency and elevating its value. Consider a scenario where you can purchase 5 video games for $20, valuing each game at $4. Each dollar is equivalent to a quarter of a game. In the event of inflation, including the rise in video game prices, let's say a year later, your $20 can only procure 2 games. Each game now costs $10, signifying that each dollar can only secure 1/10 of a game. The escalation in prices has thus diminished the purchasing power of your dollars. Conversely, in a deflationary environment, prices decline. Suppose a year later you could purchase 10 video games for the same $20. Now each game is priced at $2, allowing each dollar to purchase half a game. Consequently, the identical amount of currency enables the acquisition of more games, illustrating an augmentation in its purchasing power, usefulness, and value. Inflation is commonly quantified using the Consumer Price Index, an index devised and monitored by the federal government. This index gauges the average nationwide prices of a basket of goods and services typically purchased by the average consumer. It serves as a recognized method for monitoring fluctuations in price levels, thereby indicating trends of inflation or deflation. Furthermore, currency instabilities can impact investment values, as the dollars yielded by investments may not possess the same purchasing power as the dollars initially invested. For instance, let's suppose you lend $100 to your sister with the expectation of repayment after 1 year. Should inflation occur during this period, diminishing the value of the dollar as prices ascend, the $100 returned to you by your sister would possess less purchasing power than the $100 initially lent. Consequently, although your investment has been ostensibly repaid, its actual value has depreciated, rendering the return funds less effective in terms of purchasing goods and services. In a scenario where the value of currency, representing the units in which wealth is quantified and preserved, experiences instability, projecting investment returns becomes more challenging. Under such circumstances, investments entail heightened risk. Both inflation and deflation, as forms of currency instability, pose challenges not only to an economy, but also to the financial planning process. Fluctuations in currency value impact the purchasing power of income, influencing consumption and investment decisions. While it is common for individuals to anticipate continuity, prudent financial planning necessitates acknowledging the inevitability of encountering economic cycles throughout one's lifetime. It is imperative to proactively consider the risks associated with economic downturns, including potential loss of wage and investment income. Simultaneously, reliance on windfalls from economic expansion should not be assumed or relied upon. Bear in mind the following. Business cycles encompass phases of expansion and contraction, which encompass recessions and are gauged by the economy's productivity as indicated by gross domestic product. An economy becomes unsustainable when it grows excessively quickly or slowly, as both scenarios exert undue pressure on the economy's markets. In addition to GDP, indicators of economic well-being comprise employment and unemployment rates, currency value reflected in the Consumer Price Index. Financial planning must acknowledge that periods of inflation or deflation alter the currency's worth, impacting purchasing power and investment valuations. Consequently, personal financial planning should consider business cycles, fluctuations in the economy's productivity, currency value fluctuations, shifts in other economic indicators. Are you ready to manage your finances like a pro? I've prepared a comprehensive monthly budget document specifically for you. Simply download it now using the link in the description to kickstart your journey towards financial success. Take action and revolutionize your financial planning today. The planning process. The financial planning process entails determining your desired destination, assessing your current position, and strategizing how to bridge the gap between the two. Formally, this process involves 1. Defining goals. 2. Assessing the current situation. 3. Identifying available choices. 4. Evaluating the available choices. 5. Making a decision. 6. Assessing the outcomes. 7. Revisiting and refining goals. 8. Identifying new choices. 9. Evaluating new options. 10. Making decisions. 11. Reassessing the outcomes continuously. Personal circumstances and economic conditions are prone to change, necessitating adaptable plans capable of accommodating such fluctuations while maintaining steadfastness in pursuing long-term objectives. It's essential to remain vigilant and responsive to these shifts while ensuring your plans have a robust foundation to withstand the uncertainties brought by changing winds. Are you ready to manage your finances like a pro? I've prepared a comprehensive monthly budget document specifically for you. Simply download it now using the link in the description to kickstart your journey towards financial success. Take action and revolutionize your financial planning today. Defining goals. Determining your destination involves setting goals, which span from short-term to intermediate and longer-term aspirations, ranging from pragmatic to aspirational. Goal setting is a skill honed with experience, often guided by the SMART criteria: specific, measurable, attainable, realistic, and timely. Goals evolve over time and across a lifetime, yet amidst life's complexity and risks, having a structured plan enhances the likelihood of achieving them. For instance, upon college graduation, Sephora prioritizes immediate income to cover living expenses and repay student loans. In the following decade, she envisions starting a family and aims to purchase a home while saving for her children's education. Her income must accommodate increased expenses and generate surplus funds for accumulating these assets. In the long run, Sephora envisions retiring and funding her lifestyle solely from her amassed assets, possibly embarking on global sailing adventures. To realize these objectives, she must accumulate sufficient assets to sustain a retirement income and fund her travel aspirations. The relationship between timing, goals, and income is illustrated in Figure 1.10: Timing, Goals, and Income. Sephora's income is pivotal in pursuing her goals, necessitating a clear grasp of its origins and its role in goal attainment. Thus, she must evaluate her present circumstances meticulously, assessing the current situation. Determining your current position involves gaining clarity on your present circumstances and the options they present. While numerous choices may be available, pinpointing those most conducive to achieving your objectives is key. Assessing your current situation entails organizing personal financial data into concise summaries that highlight crucial aspects of your financial landscape, your assets, liabilities, incomes, and expenditures. These figures are typically captured in financial statements, including income statements, balance sheets, and cash flow statements, which we'll delve into later. These statements are also utilized by businesses in their financial planning endeavors. At this stage, we can evaluate Sephora's straightforward scenario by identifying her assets and liabilities, along with detailing her annual incomes and expenses. This analysis will unveil whether she anticipates a budget surplus or deficit and, more importantly, shed light on the feasibility of her goals and her progress toward achieving them. Even a rough assessment of the current situation can offer valuable insights. Sephora's assets consist of a car valued at approximately $5,000 and a savings account holding a balance of $250. Her liabilities include a student loan with a remaining balance of $53,000 and a car loan with an outstanding balance of $2,700. Regarding her finances, her annual disposable income, or take-home pay after taxes, stands at $35,720. Projected annual expenses encompass $10,800 for rent and $14,400 for living expenses such as food, gas, entertainment, and clothing. Additionally, her annual loan payments amount to $2,400 for the car loan and $7,720 for the student loan. After tallying her financial ins and outs, Sephora is left with a meager annual budget surplus of only $400. While she manages to make progress toward her short-term goal of debt reduction, the minimal surplus poses a challenge for her to kickstart her objective of accumulating assets. To achieve her intermediate goal, Sephora needs to either boost her income or trim her expenses to generate a larger annual surplus. Once her car loan is paid off next year, she aims to purchase another vehicle. However, she'll have a maximum of only $650 in savings for a down payment, assuming she can save her entire surplus. Following the payoff of her student loans in approximately 5 years, her surplus will substantially increase by $7,720 annually, as she will no longer have student loan payments, enabling her to allocate those funds toward asset accumulation. Sephora's long-term aspirations hinge on her capacity to amass productive assets, as she aims to retire and rely on her asset-derived income. Progress toward her short-term objective of debt reduction is essential before she can focus on her intermediate and long-term goals. Until she diminishes her debt, which would lower her expenses and elevate her income, she won't advance toward her intermediate and long-term objectives. By evaluating her current financial status, Sephora realizes that she must postpone asset accumulation until she can reduce expenses by paying down debt, particularly her student loans. As she progresses in reducing her debt load, her financial landscape will evolve, presenting her with new opportunities and choices. From two straightforward lists, one detailing her assets and debts and the other outlining her income and expenses, Sephora gained insights into her present circumstances. Even in this uncomplicated scenario, articulating the current situation proves highly informative. It sheds light on the essential pathways toward goal attainment, evaluating alternatives and making choices. Determining the path from your current position to your desired destination involves recognizing immediate options and devising longer-term strategies or sequences of decisions. This requires a blend of realism and imagination regarding your present circumstances to grasp the available choices and the potential future ramifications of those choices. Your living circumstances, such as family structure, age, career path, and health, along with the broader economic landscape, will shape or define the relative value of your options. Once alternatives have been identified, each must be evaluated. While considering the costs and benefits is paramount, it's also essential to assess the associated risks, where each option will lead you and how well it positions you for subsequent decisions. Maximizing the breadth of choices and ensuring they are well diversified allows for decisions to be made with an eye toward the impact on future choices. The ability to think ahead in the process enables more effective planning. In Sephora's case, as she continues to reduce her debt, one option is to persist with this approach. Alternatively, she could expedite the accumulation of assets by reducing expenses to generate a larger budget surplus. Upon reviewing her expenses, Sephora determines that significant reductions aren't feasible. However, she could explore increasing her income, presenting two choices: taking on a second job or trying her hand at poker in Las Vegas. Sephora faces two main options: taking on a second part-time job or trying her luck in Las Vegas. Working another job could boost her after-tax income, yet it would undoubtedly leave her fatigued and with less time for personal pursuits. Given the current economic downturn and increased unemployment rates, the additional job may not yield substantial earnings. On the other hand, a trip to Vegas presents the possibility of a significant windfall, with the expense of the trip being the sole upfront cost. To make an informed decision, Sephora must weigh the benefits and drawbacks of each option. While a trip to Vegas offers the potential for substantial gains, it also carries the highest risk. Losing could plunge her deeper into debt, further delaying her goal of asset accumulation. Ultimately, the Vegas option appears less appealing when factoring in its inherent risk. If it results in further debt, Sephora would be compelled to reconsider her financial strategy, likely necessitating both increased income and reduced expenses. Thus, what initially seemed like an enticing choice may ultimately force her into alternatives she initially deemed impractical due to their perceived costs. The evident risk associated with the Vegas option is the potential loss of wealth, but its more significant, albeit less obvious, risk lies in its potential to constrain Sephora's future options. Without factoring in risk as a cost, the allure of the Vegas option is apparent, a phenomenon exploited by establishments like casinos. However, when considering risk alongside the decision's long-term implications, the attractiveness of this option diminishes significantly. At times, opting for a choice with less immediate benefit but lower risk may prove wiser. Similarly, selecting an alternative offering modest immediate gains but greater future flexibility can be advantageous. Risk itself represents a cost, while choice embodies a benefit, both of which should be integral to any decision-making process. Bear in mind, financial planning is a cyclical process involving the following steps. 1. Defining goals. 2. Assessing the current situation. 3. Identifying choices. 4. Evaluating choices. 5. Making decisions. The decision-making stage entails further steps such as assessing the outcome, refining goals, exploring new options, and re-evaluating choices. Goals are influenced by various factors including present circumstances, family dynamics, career trajectory, health status, and broader economic conditions. Goals can span short, medium, and long-term horizons, and the choices made can either expedite or delay progress towards these goals. Some choices may even lead away from the intended objectives, prompting a reassessment of goals. It's essential to scrutinize available options by considering their benefits, explicit costs, implicit expenses, and strategic implications. Financial planning professionals. Even after delving into this work, or perhaps even more so, you might seek assistance from a professional specializing in financial planning. While expertise can aid in decision-making, ultimately, you bear the responsibility for the outcomes of your choices and should thus retain autonomy in decision-making. Various financial advisors, including accountants, investment advisors, tax specialists, estate planners, and insurance agents, offer assistance in financial planning. Each possesses distinct training, qualifications, educational backgrounds, and methodologies. To earn credentials, they must fulfill educational prerequisites, accrue professional experience, and pass examinations conducted by accredited organizations attesting to their proficiency in the field. Certifications serve as valuable indicators of an advisor's expertise and experience in a specific area of financial planning. However, when seeking advice, it's crucial to discern the advisor's vested interests. Understanding the source of information and advice and its implications for quality is paramount. Specifically, it's essential to ascertain how the advisor is compensated. Some advisors solely provide and receive compensation for advice. Others sell products like investments, mutual funds, or life insurance policies and earn commissions upon sale. Additionally, some offer services such as brokerage or mortgage servicing and receive compensation when these services are utilized. While all advisors may possess high ethical standards and good intentions, distinguishing among them is imperative when selecting a financial planning advisor. Occasionally, a friend or family member who understands you well and genuinely has your best interests can offer valuable information and advice. However, their perspective may lack objectivity or expertise compared to that of a neutral professional. Diversifying your sources of information and advice, incorporating both professional and informal insights, subjective and objective viewpoints is advisable. As always, diversification mitigates risk. Now equipped with knowledge about the planning process, personal influencers, broader economic landscapes, and the financial advisory realm, you're ready to delve into the specifics. The next phase of financial planning focuses on intricacy, particularly how to structure your financial data to assess your current standing and initiate the evaluation of available alternatives. Bear in mind that financial advisors can serve various roles, including accountants, investment advisors, tax advisors, estate planners, or insurance agents. It's crucial to grasp your advisor's background and how it might influence the guidance you receive. Additionally, comprehending your advisor's compensation structure is essential, as it could impact the nature of the advice provided. To mitigate risk, diversify your sources of information and advice by consulting both subjective advisors, like friends and family, and objective, professional advisors. ready to take charge of your finances with confidence. I've curated a detailed monthly budget template just for you. Access it now via the link in the description to begin your path towards financial success. Don't wait, take action and transform your financial planning today. Ready to take control of your finances. I've crafted a comprehensive monthly budget document just for you. Download it now through the link provided in the description and start managing your finances like a pro. Click the link and get your hands on the tool that will revolutionize your financial planning.